wife called me into the room today after lunch to show me an article on CNBC. But before she showed me the article, she was like, do you think the market is bullish or bearish on SpaceX? So I said, bullish. I think everybody's excited about it. Then she pulled this up. This is an article, credit here to CNBC for the article, but this is where the news will mislead you, right? They'll tell you that this is a bear trade, but at the same time, this reporter was telling us that the market was very bullish. The action was very bullish on SpaceX trade options today. Today was the first day SpaceX options traded, and the market went wild. They traded 1.1 million contracts today alone, which is equivalent to what NVIDIA trades daily on the options market, and almost as much as what Tesla trades. Tesla does about 1.6 million a year, right? But they're telling you it's bullish as they're speaking, but then they're showing you this bearish trade. So let me show you why this trade is not necessarily bearish and why there's even a typo on this slide itself, because what the reporter said didn't even match what was saying. So you got to really be careful of the messenger. So for those of you that have traded options for a while, you'll recognize this as a collar trade. It's a neutral hedge trade where in this case, the trader is protecting a position that they have while not having to pay for the insurance to do that, right? To get that protection. So let's break it down, and then I can show you on the chart. I'm gonna give you some visuals to show you how this trade actually works, right? So there's most likely one big missing part of this trade though that the news is not telling us, and I'm gonna get into that. But they show you this trade here just to be sensational. The main reason anyone takes a trade like this is to protect the position they already have. The article is playing into your ignorance, so don't let them lead you astray. And so let's get to options school a little bit. So let's take a look at the trade. The first part of this trade from top to bottom is we're going to sell a call. Normally when you buy a call, right, you're taking the position that you think the price of the stock is going up. That's how most people learn about calls and puts. They learn about them by buying calls or buying puts. So in this case, however, the trader chose to sell the call. So they're actually leaning the exact opposite way. So this was my first hint that there was something up in this trade and we needed to pay a little closer attention. And we'll see better on the chart in a second why this part of the trade is really the key to tell you that there was something missing and that the news was leaving something out. So in this case, the trader sold the 225 calls that expire in September, 3 months from now, meaning they don't think the price will get above 225, which in and of itself is bearish. So for this sale of these calls, they collected $31 million. Now, the second part of the trade was that they bought a put. So they took the $31 million and they went ahead and they went and bought a put. So when you buy a put, you're taking a position and where you think the price of the stock is going to go down. Also bearish, right? So we have two bearish things here, but we're going to get into why that might not necessarily be the thing. In this case, they bought the $205 puts for the same expiration, September, which is about 5% lower than the 215 SpaceX is trading at right now when they took this trade. So the slide was misleading here because they said they paid 31 million for the puts, but it was actually 30 when you actually listen to what the reporter was saying. So what really happened here was they sold a call for 31 and collected 31 million, and then they took that 31 million and turned around and bought 30 million worth of puts, leaving them with a spread of $1 million to keep for themselves. So notice now you have a call sale at 225, and then we have a put buy at 205. So there's a $20 gap here that we'll get into when we look at the chart. You'll see where that gap comes in and what happens when you say that. So now you say, all right, Yardie, both parts of this trade are bearish. So why is this not a bearish trade? And the first thing I'm going to tell you is no trader in their right mind takes this kind of risk by selling naked calls. And that's what they'd be doing if you take this trade on face value on the slide here. Is they'd be selling the call with no protection whatsoever. The margin requirement for this would be astronomical, especially when you're talking about 700 or 7,466 contracts being sold, right? So the broker would just say, no way, this is just impossible. It's too much money that we have to hold, because we're talking about SpaceX, right? This is a type of stock that in any moment can just take off literally and then leave these guys holding the bag. So let's take a look at the chart and see what this really means. So for the first part of the trade, they sold calls at 225. So you can see here on the chart, I marked that up with the red dash line. And I marked it short calls because when the first transaction you take or the opening transaction you take on any trade is to sell something, you're shorting whatever that instrument is. In this case, it's the underlying SpaceX. So they're shorting SpaceX at 225. So they are thinking that SpaceX will not get above 225 come September expiration. Now, the stock could go up past 225, come back down. What matters is what happens on expiration day in September, which is the third Friday in September. So by the third Friday in September, they don't think SpaceX will be at 225. They think it's going to be a little bit lower, right? So to close any short trade that you do, you have to buy that stock back. And this is the key to why I'm saying this trade is not necessarily what it seems on the surface. So by selling the 225 calls, the trader is now obligated, because anytime you sell an option, you're obligated to that contract. So they're obligated to now sell SpaceX at 225. Now, if they're nakedly selling SpaceX at 225, they're shorting at 225. If SpaceX on that third Friday in September is at 275, then they have to go back into the market and buy those shares to cover their obligation, right? So if SpaceX at 275 and they sold it at 225, guess what? They're now taking a $50 a share loss on 746,000 shares. Because remember, 7,400 contracts, you have to multiply that by 100 shares for each contract. So this would be like a $37 million loss for them. And if SpaceX is, trading higher than 275, guess what? This gets way worse. In fact, the second part of the trade is what makes it even worse, because remember, they paid 31 million or 30 million for the puts, which is the money they now already have spent out of their pocket or out of the sale of the calls, which makes this trade even riskier if SpaceX is actually above that 225 level. So now they've got 31 million they just spent, and then they also have the whatever they have to use to cover the shares if SpaceX is trading at, say, 275 or higher. This is not a risk that a large investor like this would normally take or would even take. It's just out of this world, the kind of risk that we're talking about if this trade were true on the surface of what CNBC was sharing. So let's take a look at the other side of the trade, the put side of the trade, and what that really means. So they bought the puts, which now gives them the right, because when you buy an option, you have rights to sell at 205, regardless of what SpaceX is trading. So if the stock drops back to the IPO price of 135, let's say, come at September expiration, they can still sell for 205 because they own the option contract to do that. So this is where you want to think about this as insurance. And let's take a look at why, right? So what's really happening here for this call side trade to actually work, and for this trader to not have to put up some astronomical amount of money to cover themselves, which is really where the missing link is, and the part that CNBC left out. This trader probably owns a ton of SpaceX trades, right? They actually probably own 746,000 worth of SpaceX shares already in order to cover, right, the calls that they just sold, right? So this is where you get this idea of what they call a covered call. So we're selling calls above the price for which we paid for the stock. So they already own the stock, and now they're selling calls and collecting premium to do that. And then they took that premium, in this case, and went and bought more protection with puts at 205. So that's how this trade works. So now SpaceX IPO at 135. So if the stock is above 225 by September, this trade could get the trader to have their shares taken away from them or called away, right? But this is fine because remember, they got paid $31 million in order for that to happen. So they have that profit already tucked away, and then someone is going to come along and buy for 225. Now, if they got the shares at 135 and they're selling at 225, they just made a $90 profit per share in 3 months, or 67% return, which is excellent by anybody's standard, right? So to me, this is where, the misleadingness of this trade kind of comes in. It's not necessarily bearish because they're thinking, hey, if it gets above 225, I'm good. I'm going to take my profit. I'm going to go home. The other half of this trade is where the specialness of the collar strategy comes into play, right? The other half of the trade is bearish. But if we think about the fact that now we've kind of said they own these shares already. This now makes sense that we bought insurance to protect ourselves to the downside as a trader. So now what they're saying is, hey, if it gets below 205, I want to sell it at 205. I'm not going to hang around any longer below that. And so if the stock come September is trading right, let's say right back down to, it's 135 IPO price, then that's going to be a nice $70 share return, which is 50% return to them in 3 months, which again is an excellent return, right? You're talking about, 50% in 3 months. You do that 4 times, 200% return on your money. So this is not necessarily making this bearish. They are just setting their exits where they want to lock in their profits, and they're using the market's money to do so because they sold the call in order to buy the put, and that is what you call a collar. So when you own shares, you can protect your shares and you protect your profits by selling a call above a level you don't mind letting the stock go at, and then turning around using that premium you collected and buying a put to protect you at a level where you don't want to be in the stock if it drops below that level, right? So when we look at this now, right, here's the best part. If the stock stops and stays between 205 and 225 come September, guess what? They get to keep the $1 million difference between the 31 million they sold the call for and the 30 million that they used to buy the put. So they're going to get to keep that $1 million anyway, and then they get to try and do this strategy all over again one more time. And I got to tell you, if the stock is anywhere near 220 or whatever, they'll probably sell the call even higher, locking in even more profit, and their protection is going to probably be even higher than 205 as well. So they might be able to roll this up and lock in even more profit. So this is how the collar strategy works. I'm the Wall Street Yardie, and if you want to learn more, link me in the comments, give me a like, share this video. Mark Cuban used this same strategy to keep his billions when Yahoo bought broadcast.com, and it saved his butt because Yahoo stock crashed shortly after that. So stay tuned. We got more for you.